Hello, welcome to the fourth lecture of the Introduction to Economics 2 course. Today we will talk about the fiscal policy and the aggregate expenditures. In the chapter 4 of our textbook, we can see that the main details about the fiscal policy and the aggregate expenditures. In here, or in this chapter, we can try to understand the effect of the taxes or government expenditures on our aggregate expenditure and income models. The learning outcomes for the chapter 4, the changes stemmed from including taxes into our macroeconomic model, the effect of government expenditures and taxes on the level of equilibrium income, implementation of fiscal policy to fight against the economic recession and inflation, and the relationship between fiscal policy and economic stability. In here, when we use the fiscal policy, we have two options. The first one is the taxes. The other one is the government expenditures. So the change in the taxes and the government expenditures, of course, will be affected on the aggregate expenditures via consumption decisions or government expenditures. So when there is a change in the aggregate expenditures, there is also a change in the production as expected. So and also the income level. For the first one, we need to see that the relationship between the taxes and disposable income. So disposable income means that the difference between the income and minus taxes. So after the taxes, we have the net income. So this income is called the disposable income. Of course, it means that you remember that our consumption decisions also will be determined by the income. So when there's a change in disposable income, there is also change in the consumption expenditures, and also, of course, the aggregate expenditures. So this change will also be affected on the our production and income. So this table and this figure shows that there is a relationship. For example, when we have increase in taxes, or when we have taxes, there is a decrease in disposable income, and because of that, there is a decrease in consumption expenditures. So this decrease in consumption expenditures also affects on the aggregate expenditures. So this increase or decrease aggregate expenditures will be affect on income. So this table and the figure shows that this relationship. So increase in taxes basically means that the aggregate expenditure function shifts upward. So because of that, there is a decrease in the production and income level. Or remember public expenditures, the component of our aggregate expenditures function. So when there is a change in public expenditures, there is also a change in aggregate expenditures. Increase or decrease. So the effect, the change in the public expenditures and the income, we can use the multipliers to calculate this relationship or magnitude of the change in the government expenditures. For example, when there is a change in the government expenditures, is multiplied as the increase in the income. So there is a positive relationship between the government expenditures and income. For example, when there is a 400 public expenditure in the economy, there is a increase in income as 2,000 Turkish lira, 1,000 Turkish lira. So it means that the 2.5 times increase in income. Or when there is a change in taxes, we need to calculate the tax multiplier. So the tax multiplier shows that the relationship between the taxes and the income. So we need to, of course, get the negative value for the tax multiplier, because this expected effect, of course, will be negative, because when there is a increase in tax multiplier, for example, because of that there is a decrease in the disposable income. So this also means that the decrease in consumption expenditures, and because of that this increase also decrease in the aggregate expenditures. So it also means that the decrease in production and income. So this example shows that when there is an increase as 100 Turkish lira in taxes, the effect will be negative or decrease in the income as 150 Turkish lira. If the change in public expenditures and tax are the same, for example 400 Turkish lira, the effect will be 400 Turkish lira on the income level. So it means that the balanced budget multiplier for the economy. So it also means that the increase taxes and expenditures are the same. If they have same value, the effect on the income will be also same value. We have two kind of fiscal policy. The first one is the expansionary, the other one is the contractionary fiscal policy. Remember the business cycles for an economy we talked about in the first lecture. There are some recovery or expansion periods and some contraction periods for the short run in the economy. For example, if there is a recession periods for an economy, it means that the higher unemployment rate. So for this term, maybe the government want to implement expansionary fiscal policy. So in here, expansionary fiscal policy means that the increase in aggregate expenditures. So because of that, this increase in aggregate expenditures, the production and income will also increase, and so maybe you can fix these recession periods. Or the other one, when there is a expansion period for the economy, it also means that the inflationary gap and inflationary pressures for an economy. So because of that, the government want to implement the contractionary fiscal policy. So it means that the decrease in aggregate expenditures also means that the decrease in production and income, and also decrease in inflation pressures. So because of that, the fiscal policy is an important part of the macroeconomic policy. So we can use the fiscal policy to control aggregate expenditures and economic stability for an economy. So lastly, again, increase in aggregate expenditures means that the increase in production and income level. Decrease in aggregate expenditures means that the decrease in production and income level. First one is implemented for the recession period. The second one is implemented for the recovery periods.